On Friday, shares of three major Chinese electric vehicle manufacturers fell amid a broad sell-off in high-flying technology stocks on the New York Stock Exchange. Hey folks, welcome back to our channel. In today's video, we will be talking about Xpeng versus NIO, competitors analysis, which is best. Before we get into the video, don't forget to drop a like and subscribe to the channel. Make sure to turn on post notifications so that you never miss a video from us. Without further ado, let's dive in. As of 11:15 a.m. Eastern Standard Time, here's where things stood in comparison to Thursday's closing rates. The stock of Li Auto was down 10.3%. The stock of NIO was down 13.7%. The stock of Xpeng was down 11.1%. Almost all of the hot electric vehicle and related stocks have been falling this week, partly due to concerns about rising interest rates and partly due to a continued sell-down of the category leader, Tesla. As of Friday, Tesla was down around 10.1%. The yield on the benchmark 10-year U.S. Treasury bond has been growing, raising investors' fears about interest rate hikes. Although the 10-year rate is still low by historical standards, it reached new highs this week for the first time in over a year. Some of the problems that are driving Tesla's stock lower are specific to Tesla and do not represent the wider potential for electric vehicle manufacturers. However, considering that Tesla's massive run-up last year was a major driver of investor interest in all three of these firms, it's not shocking that they're all falling as Tesla sells off. Having said that, the fundamentals haven't changed much. Having all three of these businesses are still far from profitability. Their balance sheets should be strong enough to withstand this market storm. China's market for electric vehicles is most likely to rise rapidly over the next few years. All three have competitive vehicles in production and growing sales, and while all three are still far from profitability, their balance sheets should be strong enough to weather this market storm. Before the US markets open on Monday, March 8th, Xpeng will release its fourth quarter and full year 2020 earnings. Li Auto and NIO are the first to publish. Xpeng. In February, Treasury bond yields started to rise sharply, and investors began to shift their portfolios away from tech stocks and toward fixed income assets and stocks in the oil and industrial sector. Stocks in the energy sector were hit especially hard, and Xpeng was caught up in the sell-off. The stock of Xpeng is still up roughly 32% over the last year, but it is down roughly 62% from its November peak. Despite currently shipping fewer vehicles than rivals NIO and Li Auto, the company is rapidly expanding its EV deliveries, and it appears that it will continue to experience strong growth. Xpeng, on the other hand, may be dragged down by a larger correction in electric vehicle stocks. The stock of Xpeng has started to fall in the early March trade. So far this month, the company's stock has dropped roughly 21%. On March 1st, Xpeng released its February vehicle delivery figures, announcing that 2,223 vehicles were delivered in February. Vehicle deliveries increased by 577% in January and February, bringing the total number of P7 midsize sedans delivered to 20,181. The company has established itself as a pioneer in China's electric vehicle sector, with a sizable addressable market to tap into. But investors should expect high volatility in the near term. Xpeng has a market capitalization of about $20 billion and trades at a price-to-earnings ratio of around 27. On March 8th, the company will release its fourth quarter performance. Xpeng expects 12,500 vehicles to be delivered in the first quarter, up 450% year over year. Revenues are forecast to rise 533% from the previous year. The company did not provide bottom-line guidance for the year, but it is expected to report another net loss as it ramps up production, invests in R&D, and expands its manufacturing footprint. The company did not provide earnings figures for the year, but it is expected to report another net loss as it ramps up production, invests in R&D, and prepares to open a new manufacturing plant in 2022. The electric vehicle manufacturer, which according to JP Morgan analysis, could capture 8% of China's electric car market by 2025, has 2 models in the Chinese market. They've made a name for themselves in an increasingly competitive market thanks to the cutting-edge infotainment systems and self-driving technology. Xpeng's third iteration, aimed at smaller sedans like the Toyota Camry, is set to debut in the second quarter. Hands-free lane switching and navigated speed control are among the features of Xpeng's XPilot 3.0 autonomous driving technology, which was recently released. NIO Inc. shares have dropped another 2% on Monday, trading at $37.36 at the time of publishing. If the Chinese electric vehicle maker stock closes in the red, it will be the 5th day in a row that the stock has dropped. It's now less than half of what it was a few months ago when it peaked at $66.99. Is NIO a stock to invest on the dip? Investors will need some calm to become selective in the current market climate, with shares dropping. For 2020, NIO and the electric vehicle market were hot, with Tesla joining the S&P 500 and EVs becoming more popular as customer demand grew. NIO's price had risen from $4.10 to $48.74 in 2020, so recent profit-taking isn't shocking. It was looking a lot worse on Friday, but the wider market recovered, and NIO rose from a session low of $31.91 to $38.11 by the close. NIO is a smart electric vehicle manufacturer based in China that designs, manufactures, and sells smart EVs. NIO is also interested in the field of self-driving cars. Disappointing results were one of the key drivers of NIO's depreciation last week. The National Institute of Health published its findings on Monday of last week. According to Refinitiv, EPS was negative 0.16 cents against a forecast of negative 0.7 cents. Revenue came in at $1.03 billion versus $1.01 billion, which was slightly higher than anticipated. This represents a 133% increase over the previous year. NIO had a fantastic year in 2020, with sales more than doubling. In Q4 2019, there were 17,353 deliveries compared to 8,224 in Q4 in 2019. In 2020, 43,728 vehicles were delivered compared to 20,565 in 2019. Deliveries of the vehicles were expected to be between 20,000 and 20,500 vehicles in Q1 2021, reflecting an increase of approximately 421% to 434% over the same quarter in 2020, and an increase of approximately 15% to 18% over the fourth quarter of 2020, the company says. Total sales are expected to range between RMB 7,382.3 million and RMB 7,557.2 million, reflecting a 438.1% to 450.8% raise over the same quarter of 2020 and an 11.2% to 13.8% increase over the fourth quarter of 2020. According to Reuters, NIO said on its earnings conference call that it would join the European market and that it was looking into joining the US market. Investors who had hoped for a continuation of the high growth rate were frustrated by the Q1 2021 delivery goals. The increase in delivery volume from Q3 to Q4 2020 was more than 40%. On the analyst call, however, CEO William Li listed battery issues as well as the well-publicized semiconductor issues. "We'd like to be more conservative in the first half of this year," says the company. "We are very positive about demand for the second half of this year," he said, "but we don't have maximum visibility yet." Following these findings, JP Morgan cut its final price goal for NIO from $75 to $70. While these results showed strong growth in deliveries and sales, the massive share price appreciation in 2020 had clearly priced in this growth and had likely priced in even stronger growth and outlook. As previously said, NIO had most likely priced in stellar growth figures, so where do we go from here? Investors are shifting to more beaten-down stocks that would likely benefit from the economy's reopening, putting pressure on tech and electric vehicle stocks. As a result, profit-taking has hit tech stocks like Tesla and other major names. This has extended to the electric vehicle industry, which has had a very good 2020. To keep up with the share price appreciation, results will have to be truly spectacular with a strong outlook for future growth. When this does or doesn't happen, the stock revalues, which is exactly what happened to NIO. This is compounded by a growing knowledge that the electric vehicle sector's playing field is about to get a lot more crowded. Consumer demand has switched to electric vehicles, forcing traditional automakers to make a transition. We've passed the point of no return, and the combustion engine's life expectancy is dwindling. As the value of traditional combustion engine vehicles depreciates, more people can buy electric cars. Volvo has stated that it will be fully electric globally by 2030. Ford has stated that it will be fully electric in Europe by 2030, and a number of other manufacturers have made similar claims. Tesla had the field to himself for a long time and was a trailblazer, but others saw opportunities and joined the field, including NIO. However, the room is becoming increasingly crowded, and only the strongest will be able to survive. One possibility is that legacy manufacturers would play in the sector by buying attractive and inexpensive EV manufacturers in order to accelerate their conversion. And with that, it's time to end the video. We hope this session was informative. Do let us know in the comments section below. Subscribe for more content just like this one and share it with your friends. Also, don't forget to smash that like button and also press the bell icon to get notified about our new videos. Until then, fellas,